Okay, let's go ahead and talk about changes in the partnership composition. Now, obviously, a partnership is a going concern. Eventually, new partners are going to want to enter the partnership. Existing partners are going to want to retire. If you think about it, some of the large accounting firms, the Big 8, the Big 6, the Big 5, and the Big 4, as partnerships, they have thousands or tens upon thousands of partners. And so every year, new people are being elevated to the rank of partner. Existing partners are retiring. How do we handle these changes in the partnership? Now let's go ahead and start first with the entrance of a new partner. Let's assume we have, of course, the ABC partnership. And let's say that the ABC partnership has capital balances of $300,000, $450,000, and $250,000, $679,000, so a total of $1 million. And let's say that A, B, and C share profits and losses in a 25, 45, 30% ratio. Now let's say that D wants to enter the partnership. That space, D wants to enter, and D is going to pay, let's say, $300,000 for a 20% ownership interest. Now, when I say 20% ownership interest, that means 20% of the total capital. Now, we know that when you buy an equity interest in a business, the chance that you're going to pay book value is essentially zero. Generally, you'll pay more than book value. If you buy a share of stock, you're almost, 99.9 times out of 100, you're going to pay more than book value. Rarely, you might buy less than book value. But the chance you're going to pay exactly book value is essentially zero, except by really bizarre coincidence. So the first order of business is going to be to determine whether D is getting in at a discount to book value, at a premium to book value, or at book value. So we're going to take the existing net assets, which are $1 million. Again, this total capital, total equity, total net assets, right? Assets minus liabilities equals net assets equals owner's equity. So there are currently net assets of $1 million. D is going to contribute $300,000. And so after D's contribution, the new net assets are going to be $1.3 million. And D is going to get 20% of that. Or $260,000. So what we're seeing is that D is paying $300,000 for $260,000 of net assets, so D is paying a premium to enter. Right? D's paying $300,000 contribution. D's going to get $260,000 in capital. Now, this is always going to be the first step. First step is always figure out is D or is the new partner paying more than book value, less than book value, or equal to book value. Once we do this, we sort of change mental gears and say, okay, there are two ways we can account for this. And as I'll come full circle back when we're done here. But basically what it's going to boil down to is we're either going to make it so that D is going to get $260,000. He or she is paying $300,000. That extra $40,000 we're going to allocate to the old partners as a bonus. This is a premium. This is the bonus that D's paying for the privilege of getting in, and that $40,000 is going to be allocated to the other partners. Alternatively, what we're going to do is say, look, we're going to go ahead and give D a capital balance equal to what he contributed, $300,000, but we're going to adjust the firm's total assets upwards so that $300,000 is 20% of whatever the total is. Let's do the bonus method first. Bonus method is real easy. Bonus method, we say, okay, there's a cash contribution of $300,000. After doing that, the total net assets are $1.3 million. D's capital balance is going to be $260. That $40,000 premium or $40,000 bonus is going to be allocated 25, 45, 30 between A, B, and C. So again, $40,000 bonus. A is going to get a fourth of that. B is going to get 45%, so 2 times 9, 18. And C is going to get 30% of that, so 3 times 4 is 12. Okay. So again, basically, any excess, or if the next video we'll have D coming in at a discount, the difference between what D pays in and his or her capital balance is going to be simply a bonus given to or taken away from the existing partners. This is easy, obviously, and also it avoids some of the sort of questionable theoretical considerations associated with our second method. So again, this is method number 1. Method number 2 is what's referred to as the Goodwill or asset revaluation method. Now, when D enters the partnership, technically the ABC partnership ceases to exist, and a new business, the ABCD partnership, arises in its place. The ABCD partnership, as a new business, would record all of its assets and liabilities that it acquired from its predecessor organization. It would record all of those assets and liabilities at fair value. You might argue that, does that really make sense? This is still the same business. All we've done is change the ownership structure of this otherwise going concern. So what we're going to do here is say, look, D paid $300,000 for a 20% ownership interest. What does that imply about the total value of the firm? So we say, look, we're going to call this the implied or apparent firm value. We'd say, well, if $300,000 is worth 20%, then the whole thing must be worth $1.5 million, right? If 20% is worth $300,000, then 100% must be worth $1.5 million. Now, the firm's net assets after D makes a contribution are only $1.3 million. So there's, again, let's say these are all, let's say all of these net assets here, those are all identifiable assets. Equipment, inventory, cash, land, etc. Those are identifiable assets. So after D writes that check for $300,000, the partnership has identifiable assets of $1.3 million, but apparently the partnership is worth $1.5 million. And again, there's a $200,000 whether you call it a differential, like we did when talking about consolidations, or excess value, as some people call that difference. There's a $200,000 differential. Why does that differential exist? Well, again, there might be misvalued assets. The ABC partnership might have some patents or copyrights that are on the books at a nominal value, but which are economically worth a great deal of money. So maybe what we should do is revalue some of those assets. Maybe they've got land or equipment which is grossly undervalued. Maybe we should revalue those assets to reflect their current fair value. Again, some people get a little leery of deviating from our historical cost and revaluing assets based simply upon a new owner coming into the business. Think of it, if you're trying to be consistent, this really is analogous to having a corporation and a new shareholder buys some shares of stock. A new owner has come in and has a partial ownership interest. Clearly, you wouldn't revalue all of the assets and liabilities of a corporation when somebody buys some new shares of stock. On a certain level, this is sort of analogous to that. So people say, look, we really shouldn't revalue our assets. So instead, or simply in the case of simplicity, we might simply ascribe that $200,000 difference to Goodwill. So let's go ahead and do that. And I've noticed sometimes that my camera goes out of focus if I go off screen, and then there's a whole blurry sequence. So I've got to stand in the middle and let it focus on me again. So let's go ahead and do the Goodwill method. Again, some people refer to it as the asset revaluation method. It's the same idea. Basically, we're going to be adjusting the value of the firm. Let's go do this. We're going to go ahead and record $200,000 of Goodwill. Now, who created that Goodwill? That Goodwill, that additional asset value, was created while A, B, and C were running the show. D came along, and based on the price D paid, D revealed that Goodwill existed, but the Goodwill was created by these people. And so that additional value is going to be allocated to A, B, and C in their profit sharing ratio. 25% to A, 45% to B, 30% to C. Okay, so we go ahead and create this Goodwill. Now D makes his or her cash contribution. And again, think of what we have in the way of net assets now. We had previously existing net assets of $1 million. We just added $200,000 of Goodwill, and we just added $300,000 of cash. So our new net assets, same thing as our new capital, is $1.5 million. And D's share of that is going to be 20%, or $300,000. Okay. So again, under the Goodwill or asset revaluation method, what we do is we revalue the partnership assets so that the new partner's contribution equals his or her share of the total capital. Basically, the cash and the capital balance, or the capital balance is based on the cash contribution. We have to adjust the total assets so that we get to the correct proportions. Under the bonus method, the partner's capital account is going to be based on his share of the total assets without doing this Goodwill, and basically any excess any excess or deficiency is going to be treated as a bonus to the other partners. Okay, that works for me. We'll come back later and do another one. One-man show. Turn this off.